Hello friends, this is Michael Harris from Price Action Lab blog. The other day I found this interesting article by Abdenoor Ayasawi about the pre and post publication performance of the dual momentum. Basically, Ayasawi showed that although the pre-publication performance from 1974 to 2013 was 17.43%, annual return at 12.64 standard deviation and a maximum drawdown of 22.72%, post-publication from 2014 to 2021 was only 5.9% annual return with 16.36 volatility and a maximum drawdown of 33.72%. So we notice here, according to Ayasawi, we notice significant deterioration of this well-known dual momentum that was published in a book in 2013 and in papers before that. So I decided to test this to see how it has done with ETFs. Ayasawi offers the rules, so we compare the S&P 500 performance over the last 12 months to USD bills. If it's higher, we either invest in the S&P 500 total return or in world ex-US equities, depending on the relative performance over the last 12 months. Otherwise, we invest in the aggregate bond. A very simple strategy. So I decided to test this yesterday, and I wrote this article. I state the rules, dual momentum, post-publication performance, selection bias, and regime changes. I did some partial in-sample performance from 2004 to 2014 because I used the bill ETF for T-bills, SPY, VU, and AGG for the assets. So I found out that in the limited sample, the dual momentum did relatively well, 7.2% annualized return, maximum drawdown 26.1%, sharp 0.43. The green line is the dual momentum, the red line is the S&P 500 buy and hold. 2013 was a good year, just before the publication, 30.43%. Then I tested this out of sample, and this is what I found from 2014, beginning of 2013 to March 9, 2023, yesterday. The annualized return of the dual momentum is 6.3%, the maximum drawdown is 33.7%, and the sharp is 0.4. The green line again is the dual momentum. The red line is the S&P, the SPY buy and hold. We see that after 2019, performance deteriorates. This is possibly due to a regime change in the bond stock correlation. After 2019, it started becoming less anti-correlated, and by the top of 2022, actually the first day of 2022, it has become bonds and stocks became highly correlated, and as you know, the 60-40 allocation suffered large losses during last year. So we compare here the performance. The annualized return of dual momentum is 6.3%, SPY ETF buy and hold is 10.8%, maximum drawdown is the same, 33.7% for the dual momentum and the ETF, and the sharp of the SPY is about 50% higher. What can we conclude from this analysis? Most of these tactical allocations deteriorate after publication, and the deterioration is normal. As I state here, it's normal because they are care-fitted and they are selected from thousands of potential allocations with many parameters. That's a huge space, selection space, so data mining bias is very large. And when a regime change happens, performance deteriorates, and there are even large losses, as happened last year, 17.4% for the allocation, basically the same as the SPY ETF. Another thing I would like to mention is that when you see allocations or timing strategies, tactical allocations with very high annualized return above like 12%, you should be skeptical because there may be care-fitting, selection bias, data mining bias. The market is hard. It's hard in the market to get these high annualized returns due to constant regime changes that cause performance deterioration. All strategies, timing strategies, tactical allocations, they tend to chaotic behavior as time passes because of regime changes. So it's important to make changes, to switch to another strategy or allocation or use proper diversification. Apparently this wasn't a good one, and that's why the results are so bad post-publication. Thank you for listening. Have a nice day.